It's the Powell put, baby. Hopefully you guys had an exciting day. I didn't lose as much money as I thought, but we'll talk about that on the watch list tonight. However, I want to talk about what happened here with the Fed and explain it. We went over this on stream. It had an effect on the market and explained why the stock market went down off of this and also for the future. So some of this stuff is kind of boring. And again, it's not the exciting trading stuff, all that, but I'm telling you, give me 10 minutes here. This is knowledge you will need forever, or it will be very useful to just understand what's going on here. There's a lot of economic concepts, so that's what I want to go over and explain to you guys because this had a big effect today. You saw it right when the FOMC, the Federal Open Market Committee interest rate decision, and also you guys could get it here too. You go to federalreserve.gov, go to monetary policy, the meeting calendars, but it came out. They did no change. They did not raise rates. The market went up a little bit, and then it started to come down, and then Fed chair, they changed it from chairman to chair, actually, believe it or not, political correctness. Fed Chair Powell, he went and he was speaking during, it's a press conference, and that's what it's called, and that was a question today on stream. He spoke during his press conference, and now the market's reacted. So why I'm saying this had a big effect on the market, because what the Fed Reserve is going to do, what they're saying about interest rates, it affects the economies and the economy. And we saw moves. We saw Wells Fargo, Bank of America, and then we saw all the other stocks move. And again, this is related to all the other stuff we've talked about. So if you're interested in the yield curve, today affected that. A lot of things got affected. So that's what we want to talk about here. So make sure you guys like the video. Subscribe if you are new. We have the watch list tonight at 7 and then be live on stream. I have an open Apple position that's huge. We're live 30 minutes before open. It is in the description and pinned to the chat. So where do I start? This is very, very complex, and on the stream I was saying this is historical and very important, honestly. So I think I'm just going to recap quickly what happened, and then for the beginners, I will explain it piece by piece to get a better understanding here. But that interest rate decision came out. It was unchanged, but here's where the highlights with it. There was two main things, even as we were reading it live on stream. These were the first two things that that came to mind. It was the interest on excess reserves and then the bond buying program. And surprisingly, these were the first two things. So this is how it looks. They issue this statement. They're saying they're not raising rates. So you guys know that. And nothing was too crazy like there. But the other big expectation was low inflation, or a big surprise, actually. Kind of, not really. But Powell was saying it during the speech. He said low inflation. It was surprisingly low. And then he blamed energy. And that was one of the first drops. One of the first drops came when he mentioned energy right here, and then it bounced. But then the next drop came here after the market. This was, I believe, he started talking around here, and that was, or no, was it? I think it was the first drop here. This is when he started mentioning asset prices. But I think the market was kind of digesting things here. We started to see it go down earlier, but essentially, as he kept talking, more info from the press conference drew the market down, as we got to see. But right from the initial report, the only thing that stuck out was the low inflation that they saw because of energy. Even core inflation was very low. So that was surprising. And again, this could have an effect on bonds, and I'm going to get there. But now where was it? The first thing was the interest on excess reserves. So now, why was this important? They haven't changed this. And previously, interest, it was higher before for the banks. So this benefited the banks, but it also hurt some. But mostly now, they're going to cut that. They're going to get paid less interest now on the reserves that they're holding. And I said this is a funny concept. If you guys, and again, I'll explain this for the beginners at the end. It's actually really funny if you're not familiar. But that had a big effect because, again, this is really what I'm going to say with all of these. This was very dovish, but very hawkish at the same time. And during the whole speech, he threw a lot of curveballs. Because why do I say this? Because something like doing this, I view as very hawkish. I see this as easing. This is a way, and again, he hinted at it during the thing before because everyone kept asking him rate cuts, rate cuts, rate cuts. He kept saying, I'm going to employ other policy tools. So these aren't main tools, but they're trying to use a lot of stuff. This is very easing, and essentially, they're going back to normal, and not normalization, but back to what we were at before we started seeing tightening and the markets come down. And why do I say that? Because then that's where the next part goes. So it's here. It's now the next part, the $15 billion rollover for the bonds. They lowered this. So this was part of the QT, the tapering. And I kept asking this in the chat. And people were like, no, it's the same. But actually, it was a change. So you could see that that's for the implementation note. That's saying what they're implementing after today. They'll say starting this date. But now you could go see here, this is March. So the rolling over at the auction, here it is. It's saying $30 billion. Their rollover proceeds, the excess $30 billion, and then $20 billion. That is for March. Then January, it is again $30 billion, $20 billion, and then here we have $15 billion, $20 billion. So they lowered this one by half on the thing. So this is this is easing, because what it's going to do now, there's not the requirement was $30 billion to roll over the proceeds from the treasuries, but now it's half of that, so they could go take those and now buy bonds again. Bonds, you guys see what bonds are doing with the economy and everything, but if there's more demand on the longer term bonds, that's going to flatten the yield curve more. So then this is what I'm saying. Overall, this was a lot of easing, but the market didn't take it as such. The market just took no rate hike, but I think a lot of people blew by this. But then during now the conference call, I keep calling it a conference call, the press conference with Chair Powell, a lot of other stuff came out that adds to this, but this right away caused the rip in gold and the drop in the dollar, because this is easing. Again, if it's lowering the interest on excess reserves, it'll help some banks and hurt some, but for the most part, this is making it where they're not paying out as much money. The Fed's able to keep more money, and it's still kind of, that is probably going to lower the standards for the banks. That's why, again, why I think they responded like they did. They went down at first, and I'll tell you why they went up. But the next part, too, the bond rollover, this is just going to be a bond buying program. Look at Japan. This is normal for central banks. So, again, if none of this makes sense, I'm going to explain more of this for the basics for you guys to really be able to digest this. But this is all very, very important stuff here. So that's what caused that move. These are the changes that were made. So these are important. And then the follow-up call. But again, even for the beginners, this has an effect. As you see, it brings up banks, how much the banks make. Banks make up a big portion of the stock market. Any companies borrowing, corporate debt comes up. It affects how much companies are making, even foreign exchange. So all of these factors are coming into play. So now, during the press conference, though, there was now more things that came down. Although this was easing, I thought this was very bullish, because this is going to be accommodative towards the market. That's why we'll see if it bounces here in the next few days, which I'm sure we might see. Or if we, I made that video yesterday. I didn't think it happened that quickly, but we'll see if the volatility picks up here. But for the most part, I think the market might see this as positive. Again, if the market sees it as easing as well as I do, they might see that as fear, but it's not a rate cut, which is, again, that is going to be the big boy. I think that's the one that really matters here. So, again, that's the effect of it. But as he kept talking, they asked about valuations of prices, and now the banks started to rip. You'll see right here, it was like, what, 12.15 or 2.35? What am I saying? You see right here, this was within 5 minutes. It starts dropping, and the banks start ripping when the banks were dropping before, because the first report didn't really benefit them too much. And again, it more easing. But now when what he said, he was asked the question, or he was kind of explaining it, or someone asked him, and pretty much he got to the point of saying that their decision, they were doing the stress, he kept saying stress tests. They've been doing this, I think this 3-day summit on economic evaluation or something. But he said this is their initial assessment with the moves they made today that the banks responded negatively to. He said that's the first move, the interest on excess reserves and all that. But he said they're not too sure on how this is going to affect future policy, or if this will signal anything there. But pretty much it was uncertainty out of Powell. It brought back the reminders of the hawk in Powell when last time he goes, oh, it's just autopilot. And he has, I guess, his problem. I like Powell, but I think the issue is he underestimates a lot of this stuff. But I guess that's his job too. So that is where, people started to panic. It did a little good, but then the next question started to come. It was asset valuations. He started to say, asset valuations aren't high. People kept grilling him on a rate cut. He kept avoiding it. again, energy and when he brought up energy and inflation, it being low, and he, again, underestimated, really. He said it's going to be transitional. The low inflation is going to reverse. However, you saw these effects. So that is the explanation. Now, for beginners to understand this, why did this affect the market? Again, it has those, it affects all of the aspects of deep economics. But more importantly, though, even if you want to understand the base case, when they raise rates, it makes rates higher, it makes borrowing more expensive. That is not accommodative to business and the stock market and banks and borrowing, everything like that. So that makes it slow down. We've been raising rates, and now that's the issue, is that after we've raised rates, the market didn't like it in October, and then again, the trade wars and all these other issues. So then we stopped raising rates. They're still higher than they were, but then other policies the Fed were doing, they're backtracking, like quantitative tightening, selling bonds, reinvesting, all that. But back to the main point, it just has to do with demand. When rates are high, higher interest, it makes it more expensive to borrow. That slows things down. When it's low, you want to, lower interest encourages buying, so on and so forth. And people ask, would a rate cut be bad? Well, it spurs growth. So why would a rate cut be bad? Because we're at the top of the cycle. So if business is good, they're saying jobs are doing great. Trump could brag about whatever he wants and all that stuff. But we cut rates to spur growth. I thought we're growing. What do we need to spur? That would be a negative signal in the market. But if we were at a bottom like 2010, 11, and we're coming up and they cut rates from there, that's helpful because there's not as much, there's stagnant growth. So that's why here they didn't raise rates. That's good. The market liked it. That's why you saw the pop. The market doesn't want higher rates here, but also the market is scared of a rate cut. So even though Trump is saying a rate cut, there's many things to it. But at the same time, now you could see these effects, but now it's also the future, because when they say, oh, we're going to cut rates or this and that, people are responding to what happens, but now the expectation. So based on the reports that were made now, the federal open market, the interest rate decision, and then the conference call, the moves in bonds and everything, and even that's how they price in expectations for a rate hike. So the expectations for a rate hike in 2019 actually jumped 3% after today. And how do you tell? You look at bonds. It's because there's bonds up until those dates out for 1, 2, 3 years. When the bond market starts trade, those are interest rates on the longer end. You get to start seeing if people are expecting other rates to be trading at a lower price, they're basing that off of the front end of the curve in the short term and what the Fed is going to do. So that tells you stuff. So bonds are boring, but we balling off boring, baby. So that is kind of the beginner analysis with it. And today, and when he spoke, this is why the Fed could move the markets. It's all about accommodative policy. It says lower rates or higher rates. Are they buying stocks? And again, that's a little bit deeper, but are they creating an environment where there's cheap money and it could spur activity and growth, or are they tightening it? Because when they do that, and then again, too, the Fed is saying economics. The Fed is responsible for inflation, and now why is that important? This is very important here because when they say inflation, low inflation, this is telling you stuff about everything. This is telling you about the stock market. This is telling you about prices. And sometimes if inflation was low and, they wanted inflation to be higher, or surprisingly, you have to ask yourself, why is that? And what else could be moving from that? So that could cause people either selling things or charging more. That could say something with supply and demand. But all of these are reasons why it moves the market. But for the Fed, it's the interest rates and as it affects borrowing. And now, let me get to the interest on excess reserves. Think about the banks. These are multi-billion-dollar companies, the financials, XLF, all of them. They make up a big portion of the stock market. So banks make a lot of money. They make a lot of money with everybody's money. So policy like what they could borrow at and the rules and regulations, that's important. That's why news and stuff like Fed or government changes really affects stocks like that. And even healthcare, when you see government changes, there's certain news and stuff that has real effects because of the tangible and material effect on business. But back to the interest on excess reserves, this was implemented after Dodd-Frank, what the Fed started doing. This is why I think it's funny, because even when there was the other Fed chair, Janet Yellen, they grill them on. They used to grill her in Congress. The Fed has to go before Congress, I believe, twice a year, and they do like an interview and they ask them about what they're doing and all that. And this comes up a lot because after the crash and everything, they implemented this where the Fed will pay you interest. So think about the term interest on excess reserves. They will pay you money, a bank, interest amount on excess reserves. So banks are required to carry a certain amount. If they take risks, if anything happens, they should be able to accompany a certain amount of loss. So they should have, for all the dollars invested in holding, they need a reserve amount to back that. So if you to keep bank, this is why they wanted banks to keep money and be liquid and provide an incentive. So if your bank had more than the required reserves, you got to collect the interest on it. So, and what's the rate on it now? So there it is. So here you see they set the interest rate on excess reserves at 2.35%. So this is going to explain why today was important. But think about that. So they get paid 2.35% on any excess reserves they're holding. So this was the problem from 2010 up until they started raising rates. Rates were at zero. So this allowed all your big banks to go to the Federal Reserve. They could go borrow $10 billion, and then they didn't have to use it. They would just borrow it. And then again, here's the kicker. They were borrowing it at 0% interest, or like 0.05 or whatever, even if they got it at 0.5%. And they would borrow it at that part, $10 billion or some ridiculous, ludicrous amount. And then they would go put it in their bank, and then they would hold it in their reserves. They didn't need the money. They would just borrow to put it in their reserves. And now they would get paid 2.5% on it, or now they've lowered it to 2.3. So this was the issue. They bought this before Congress because they're saying, well, why are taxpayers paying for this if literally you created this monetary system and part of this, Dodd-Frank, everything to fix it, you're paying banks 2.5% on any amount they want, and they could borrow from the government for free. So this is why, and again, that's accommodative though. That's why low rates is beneficial, because the banks take that money. What do you think? They're making money. It's supposed to have a trickle-down effect, but we won't get into that. But hopefully you see the idea here. So now it's at 2.35. So when it was at 2.5%, they lowered it 15 basis points. That's because at 2.5, that's the current rates. The rates are at 2.5 between there right now, I believe, right? Or 2.25 to 2.5. So banks weren't getting paid on excess reserves. There wasn't an incentive for the banks to stay liquid. So by lowering this, banks now could at least skim a little bit of a percentage on the fluctuations and kind of benefit off of this somewhat. But that's a big issue. But you see how that affects the economy, though. It affects the economy, it affects the stocks. It's related to politics. It's related to your everyday life, even if you're a voter. Josh Answers, baby. We're running for president eventually. So get your voter card in. Identify as Colt. But at the same time, in all seriousness, this is very important stuff, and it's kind of complex, but literally it's simple. Interest on excess reserves. It's just the deeper understanding of how it comes into play, but that was big there. And then now the bond buying program, what that is now. So you see the Fed, and I've talked about this. This is how the money gets put into the monetary system. It's not like the government prints money. That's what the Fed does, and the Fed doesn't just send out checks. They could print new bills, and then they go buy government bonds. So what do? They print a bunch of new money. They buy a bond from the government. So the government takes that new money, and then the government says, we'll pay you back with interest. And then the government takes that money, and then they pay their workers, pay whatever else, expenses, contracts, and that money gets circulated through the monetary system. Boom, you got the new blue face hundreds. That's how it happened. Federal Reserve, shout out Yellen, everyone else too. But at the same time now, that stuff occurs. Think about what happened. That's what the Fed is doing. They're literally buying bonds from the government. So you could even check here on the balance sheet on their website. So here on the website, again, this is the same where we got the meeting and everything. You could do Federal Reserve quarterly report on the balance sheet. So we'll check here. I don't like HTML. So we'll click here, get the PDF up here. You'll see their balance sheet, and you'll see what they're invested in. This is like a balance sheet. Isn't it funny? It's like quarterly earnings for the Fed. Isn't that, you guys must like this, huh? Shout out earnings season. But you get to see what their assets are, what they're buying. You see, this is like $1 trillion, I believe. Yeah, this is in billions of dollars. So they have U.S. Treasury securities, mortgage-backed securities, and all this. What else is there? Federal Reserve notes, money in circulation, all that. But again, you see, they literally own $3.7 trillion of government bonds, and then even then, mortgage-backed securities. So I'm in real estate. That's why I told you guys, real estate and stocks. You guys don't believe me. Oh, yeah, I'll tell you. The real estate course, it's on the same link for the stream alerts. If you listen this far, you put in the code COLT. You'll get 50% off. But real estate and stocks are related, and even then with that, think Fannie Mae. You guys remember FNMA? We saw the play. People were saying the takeover. Well, this is Fannie Mae, Freddie Mac. This was before the crash. These were publicly traded companies, you guys. But now they're owned by the government because the government bailed them out. So the Fed buys mortgage-backed securities to fund loans to help the real estate market stay up too. Isn't this mind-blowing? It's all related. Finance, banks, loans, everything. It's kind of boring, kind of fascinating, but there's a lot to it. So that is what they're buying. But now go back to the bonds. This is to what happened today with, again, what did they say on the note? They're rolling over the bond payments. And like I said, they changed this for the first time because, like I said, they're buying $3.72 trillion of bonds from the government. They've been doing that. So every month, some bonds mature. So bonds they bought 10 years ago, 5 years ago, 3 years ago, some of them mature today or during the quarter. So they take the payments, and now they're saying this is the policy. Before, when it was a few years ago or a year ago, it was that they would reinvest it. The policy was you take the payment, so then a bond from 10 years ago, they'd get the interest and all the money back, and then they would put it all back into another 30-year bond to keep the market, the money in the system, liquidity. Again, more money in the system. It's easier to get hands on dollars. It spurs things, but guess what? That creates inflation. More money drops prices. Are you guys following along with me here? So that's basic supply and demand. So what happens from there now is they used to do it. It was accommodative. They would reinvest all of the money. But then as they started to raise rates and tighten and be less accommodative, what they did was they started to raise that amount now. So they're saying we would only reinvest if it was above this amount of money. So they said $30 billion. Anything below that, they would put it into their cash pile. So now they lowered that because they're easing up. So they went from 30 billion to 15. So now they're just saying today, it used to be anything over 30 billion in bond payments we got back today, we would reinvest. But now they said we'll do it to 15 billion. So they cut that in half. So that's interesting. But again, that could spur the economy. And that's why I said they're not going back to normalization. And that's a whole normalization just means getting rates back to a historical thing. But that could get me going for another hour. But at the same time now, they're coming back to where they were, where the policy was. They're trying to find a balance before we started raising, and they're really finessing it. That's why I said this is very historical and important how things shape up from here. And why I say that now for beginners and everyone else, putting this all full circle, it's because of the moves Powell made. It was very, he's not trying to cut rates. He's not trying to do anything like that, but he's using tools like interest on excess reserves, and he's also using the rolling over, and I think he has a few more tricks up his sleeve here. They're going to implement stuff like that before, they're finding ways to create ammo without having to cut the rates. So I think it's very interesting, and I don't think the financial, we haven't seen anything like this really throughout economic history and theory. So this is it's a brand new take on monetary policy, I think. If I'm wrong, too, please correct me. If you guys have any evidence for that, contribute, add to the discussion, put that below. So I'm going to leave it there. I know I said 10 minutes, but hey, hopefully you learned something. Love you guys. I'll see you on stream in the morning in the watch list tonight at 7. Let's go.